Today we are looking at a currency calculation that has attracted attention among people who follow the Vietnamese dong, and it also raises an important question for Iraqi dinar followers. What would an extremely large currency appreciation actually mean in practical terms? The discussion centers on a hypothetical scenario in which one Vietnamese dong, or VND, rises from approximately $0.3,832 to $0.20. At the current quoted value used in this discussion, that would represent an increase of approximately 521,821%. That number is mathematically correct based on the starting and ending values, but it is extremely important to understand what that percentage does and does not tell us. The calculation itself is straightforward. If one Vietnamese dong is worth $0.3,832 and the hypothetical future value is $0.20, you divide $0.20 by $0.3,832. That gives a result of roughly 5,219, 21 times the original value. When the original value is subtracted and the result is expressed as a percentage increase, the increase comes to approximately 521,821%. In other words, the hypothetical value would be more than 5,200 times higher than the starting value. This is an enormous move, and that is precisely why the percentage can sound so dramatic. But there is an important distinction between a mathematical scenario and an economic forecast. A calculation can tell us what would happen if the exchange rate moved from one number to another. It cannot tell us whether that move is likely to happen. The fact that a currency could theoretically rise by hundreds of thousands of percentage points does not mean that monetary authorities, financial markets, or economic fundamentals are pointing towards such an outcome. For anyone following the Vietnamese dong, this distinction is especially important. Vietnam operates a managed exchange rate system, meaning the value of the dong is influenced by monetary policy, market conditions, foreign exchange flows, trade, inflation, interest rates, and decisions by the State Bank of Vietnam. A major appreciation would therefore require significant economic and policy changes. It would not simply happen because people have held the currency for a long time, or because holders believe it deserves a much higher value. This brings us to the statement that someone might not consider a move to 20 cents worthwhile after holding VND for many years. From a holder's perspective, the potential return can certainly look enormous when expressed in percentage terms. If someone purchased a currency at a very low exchange value and it genuinely reached $0.20 per unit, the nominal change would be extraordinary. However, the practical outcome depends on much more than the percentage increase. The number of currency units held, the original purchase price, transaction costs, exchange fees, taxes where applicable, and the actual availability of buyers or financial institutions willing to exchange the currency would all matter. This is also where Iraqi dinar followers should pay close attention, because similar mathematical discussions frequently appear around the IQD. You may hear calculations involving $1, $3, $4, or other proposed exchange rates. The mathematics behind those calculations may be simple, but the economic question is much more complicated. A hypothetical rate does not become an official exchange rate simply because someone can calculate the value of currency holdings at that level. For the Iraqi dinar, the same principle applies. Any meaningful change in the official exchange rate framework would involve monetary policy, economic conditions, foreign exchange management, government decisions, banking sector development, fiscal policy, inflation, reserves, and confidence in the financial system. The Central Bank of Iraq has the authority and responsibility to manage monetary policy within its legal framework, and therefore claims about a future rate should always be separated from confirmed policy announcements. The VND example also demonstrates why percentage gains can sometimes create unrealistic expectations. When the starting value of an asset or currency is extremely small, even a large percentage increase can be created mathematically by multiplying the original number many times. But moving from a tiny exchange value to a much higher exchange value is not merely a matter of changing a number on a screen. It can have major consequences for exports, imports, wages, business competitiveness, government finances, foreign investment, and domestic prices. For Vietnam, a dramatically stronger dong could make imported goods cheaper in local currency terms, potentially benefiting consumers and businesses that rely heavily on imported materials. At the same time, however, Vietnamese exporters could face challenges because their products would become more expensive for international buyers when measured in foreign currency. Since Vietnam has a major export-oriented manufacturing sector, exchange rate competitiveness is an important consideration for policymakers. That is why a theoretical jump to 20 cents cannot simply be viewed as an automatic benefit for everyone holding VND. A stronger currency can create winners and losers throughout an economy. The same principle applies to Iraq. If the Iraqi dinar were to appreciate significantly, the impact would extend far beyond people holding physical dinar notes. Import prices, exporters, government revenues, domestic businesses, consumers' salaries, banking activity, and the competitiveness of Iraqi products would all need to be considered. There is another critical issue: redenomination versus revaluation. These terms are sometimes mixed together in online currency discussions, but they describe very different processes. A redenomination changes the numerical denomination of a currency, often by removing zeros, while a revaluation or exchange rate adjustment changes the currency's value relative to other currencies. If a government removes zeros from banknotes, that does not automatically mean holders become dramatically wealthier. The purchasing power and accounting relationships would have to be considered. For Iraqi dinar followers, this is one of the most important lessons from the VND calculation. A large percentage number is attention-grabbing, but it should never be the only factor used to evaluate a currency story. The better questions are: has the central bank announced a policy change? Has the official exchange rate regime changed? Are there documented reforms supporting the change? What are inflation and reserve trends? What is happening with banking sector modernization? Are international financial institutions reporting developments consistent with the claim? In the short term, the VND discussion is best understood as a mathematical illustration rather than evidence of an imminent 20-cent exchange rate. The approximately 521,821% figure tells us exactly how dramatic the proposed move would be relative to the quoted starting value. It does not establish that the move is expected, approved, or economically sustainable. In the long term, however, the broader conversation about currency valuation is valuable because it highlights the importance of economic fundamentals. Sustainable currency strength generally depends on factors such as productivity, inflation management, fiscal stability, external balances, investor confidence, and credible monetary policy. For Iraq, banking reforms, financial system modernization, diversification of government revenues, investment, and broader economic development remain much more meaningful indicators than speculative rate targets circulating online. There is also a psychological element to currency speculation. When people hold a currency for years, they may naturally become emotionally attached to the possibility of a major appreciation. That can make very large hypothetical numbers especially compelling. But responsible financial analysis requires separating hope from evidence. A currency holder can examine a scenario and calculate the potential value without assuming that the scenario will occur. So, if someone asks whether moving from $0.3,832 to $0.20 represents approximately a 521,821% increase, the answer is yes, mathematically. But if the next question is whether such a move is likely, that requires an entirely different analysis. There is no mathematical formula that can guarantee a future exchange rate. Exchange rates are determined by economic forces and policy decisions, not by the length of time someone has held a currency. And this is the key takeaway for Iraqi dinar followers as well. When you see an online claim suggesting that IQD or VND could suddenly reach a dramatically higher value, look beyond the headline percentage. Ask whether the information comes from an official central bank statement, a government announcement, a documented policy decision, or credible economic data. If there is no evidence supporting the proposed exchange rate, it should be treated as a hypothetical scenario rather than a confirmed development. The responsible approach is to remain informed while maintaining realistic expectations. Currency markets can change, monetary policy can evolve, and economic reforms can influence exchange rates over time. But major valuation changes are complex events with consequences across the entire economy. They should never be presented as guaranteed windfalls. For now, the 20-cent VND scenario remains a mathematical hypothetical. The approximately 521,821% figure is correct based on the quoted starting value of $0. $0.0003832, but the calculation itself should not be interpreted as a forecast. For Iraqi dinar followers, the same standard applies. Focus on official policy, economic fundamentals, credible data, and confirmed developments rather than unverified exchange rate promises. Thank you for watching Iraqi Dinar News. Make sure to subscribe to the channel and like the video for responsible and factual updates on the Iraqi dinar, Iraq's economy, and important developments across the global currency landscape. As always, stay informed, stay cautious, and verify major currency claims through reliable sources. This content is provided for informational and educational purposes only and is not financial advice.